so we're going to hit probably the more important, more often used profitability measures. So we're going to nix a couple of these. And we're going to stick with the ones that are probably the most commonly, valued and calculated and mean the most. All right, so we're going to stick with these guys here. You might have a problem or so on a homework only because I couldn't eliminate all of them because some are like 6-part problems, but the values, it's just embedded in the problem. I can't get rid of it. So pretend it's not there. Okay. Profitability measures, rate earned on stockholders' equity. Oop. So it's net income divided by average stockholders' equity. We do the same kind of thing here. Net income, there you go, net earnings, divided by average stockholders' equity, which you get from the balance sheet here. And average means beginning plus ending divided by 2. So, Lowe's rate earned on stockholders' equity, 152%. It's pretty significant. The idea is how much of your net income is driven by your own stockholders' equity in the business, right? Stockholders' equity. Think about what it has: your common stock, your common stock, preferred stock, if you have any, retained earnings. That's a big number that's usually in there, right? So the idea is that your net income is being driven significantly by your stockholders' equity. Okay, so net income is really high compared to your overall stockholders' equity. All right, now. Their previous ratio is 48.6%. Okay, so definitely better off in the current year. Home Depot. All right. Now here's the thing, right? We have these crazy negative numbers in Home Depot. Remember they've got, oh, there we go. Sorry. Oh, sorry, we're talking about leverage now. All right, let's talk about the basic concept of leverage. The idea here is if you've got, there you go. You've got two companies that look the same, right? They have assets of 100, but company A is using less liabilities, more of their stockholders' equity to run their business, and company B has more liabilities, less stockholders' equity. So really, they're running their business more off of stockholders' equity. And if they have the same amount of net income, what we're seeing here in company B is they're almost borrowing other people's money in order to grow their business. Now you may think, well, wouldn't you want to grow your business based on your stockholders' equity, your own earnings? Actually, if you've ever heard of a company that's highly leveraged, what that means is that they're borrowing other people's money in order to earn their own money. So you can then do what you want with your own money because you're borrowing other people's money to grow your business. Apple, super common. Everybody else, super common. The accountant in me hates this. Because the accountant in me says, no, we should be growing from our own earnings. Company A is the better way to go. Really, company B is more common business practice. The idea is that, if you are using your stockholders' equity to generate that net income, in this example, you're at 13%, right? Versus you're at this one, you have only put in a very small amount of your own money in order to generate that 10. You're actually earning 40% on your equity. So you're earning better. You're earning more using other people's money to grow your business. I know. I'm not crazy about it either, but I'm also not a finance person. I'm an accounting person. Okay, so there we go. Grab Home Depot, 11,242, divided by their stockholders' equity, which again are these negative numbers. Unfortunately, that negative number really makes this a crazy calculation, and it means a whole lot of nothing. But what's happening here, if you remember looking back at that higher percentage, they're growing their business based on using other people's money. So they've got this 4281, they're killing it, right? Because they have very little of their own assets in play. They're making that net income off of primarily liabilities. All right, this, again, meaningless. Okay, earnings per share. You may have remembered me mentioning it in the very first video. Earnings per share is the only calculation that's required to show up on the financial statements. Not that a lot of these are already on the financial statements, or they're included in the analysis, but the actual major financial statements that get published, earnings per share is required to be in there. It's because people like this one. It's net income minus any preferred dividends over common shares outstanding. Now there may or may not be preferred dividends, but the idea with this is how much is the company earning on behalf of a single shareholder. All right, so we grab the net earnings number there, 11,242, and watch, you see that they're down here. Like I said, they're required to be here, so we should come up with 1029 in our calculation. But you've got 11,242 minus any preferred dividends. Not everybody has them. They do not. So 0. Divided by number of common shares outstanding. There we go. Oh, they don't even tell us how many common shares are outstanding. How do we do the calculation? Oh, they tell us, sorry. Basic weighted average common shares, 1093. 1093, so that comes out to $10.29. Is that good, bad? I mean, it seems like it's a good number, but again, you can't do these things in isolation. One number means nothing. It's a comparative thing. All right, so let's grab Lowe's numbers. All right, we have their earnings. And again, see, here they are. Should come out to $5.49. 42.81. And they have preferred stock, but none's been issued, so that's not even a thing. But they do have the number of shares outstanding right there. And the average of that is 782. So 42.81 over 782, 549. So for every single share of stock that's out there, not that they're giving it to the shareholders, but for every share of stock that is owned, 549 of that, the company's earning $5.49 for every shareholder. So the idea is that, this number is the one that people watch. And, regular people watch this number, and companies are aware of that. So they're very cognizant of making sure that their numbers stay good for earnings per share. Unfortunately, that leads into sometimes a little income manipulation, but that's a whole nother conversation. Okay. All right. You can't compare one to the other. It's going to be because Home Depot is clearly a bigger company. The better thing to do is compare Home Depot from one year to the next, their earnings per share. And, if we went back, we would see a crazy earnings per share for Lowe's because this, right? So you had that crazy year in the middle with the huge expenses. But 409 to 549, that's a reasonable jump. Something, again, happened in here to bring down your earnings to make that number lower. So their earnings per share did not look great that year. Okay, sorry, I digress. Let's go back to where we were. All right, so let's take a look at these guys. PE ratio, dividends per share, and dividend yield. So we need the current stock data in order to make this worth anything. This isn't going to age well, right? Because this is, obviously I'm recording it this year. All right, price earnings ratio, but the calculations don't change, so it doesn't matter what year I'm using. All right, price per earnings. Let me pause this. All right, the date of this screenshot, that 277.89 is the price per share. Pretty high, right? The volume being traded, 1.57 million, well, 1.57 million, 58 million. The price, the lows and the highs of the last year, 140 to 292. I definitely took this screenshot last year because numbers are way down now. And institutional ownership. So I just want to kind of hit some of the things that they show you on here. Institutional ownership is how much of it is owned by things like mutual funds and whatnot rather than individual shareholders. Okay. Market cap, how much is being traded? That's shares out, 1.1 billion times 2. What is the overall value? That's what that's telling you. 1.1 billion shares are out in the world at 277.89 a share. So the overall value, market value, is 298.9 billion. Okay, billion with a B is the value of Home Depot being traded out there in the world, rather. The beta. Beta is how much does it stay in line with the overall stock market? Okay, so a little example of beta here. Beta is about volatility. So a beta of 1 means as the market goes up by 1, so will Home Depot go up by 1. All right, so it's how tied is it to the market. So if the market goes up 10%, Home Depot would go up by 10%. But Home Depot's got a beta of 1.03, meaning that it goes up by 10.3%. So it's a little teeny little bit more volatile than the market, but it basically, for all intents and purposes, is tied to the market fluctuations. Okay, so if there's a drop in the market, it's going to drop, and so on. PE ratio, we're going to calculate this. That is the price divided by earnings, 23.99. So that should be that should be the number I'm going to grab in a second that's going to come up with. And there's our earnings per share number, but that's a current earnings per share number, right? That constantly changes. That's not the one that's put out on the financial statements. That's the one that's currently, for the day. That's their earnings per share. All right. So the idea of PE ratio, the price divided by the earnings per share, 277.89 divided by earnings per share. So you need that earnings per share number in order to come up with the PE ratio, 23.99. So the idea is that the price of the stock is almost 24 times higher than what the company earns for every shareholder, the earnings per share. Pretty high, right? Lowe's, on the other hand, let's take a look. We've got the same data for Lowe's, right? It's it's trading at 171.36. And the PE ratio is 24.2, and the earnings per share is 708. Well, that's what we're going to come out with. Oh, sorry, I had that in the wrong order. 24.2. Hang on, go back. There we go. PE ratio is 24.2, and the earnings per share is 708. So the idea is that Lowe's is actually pretty similar, but you're paying a lot lower of a price for Lowe's, but they're kind of earning the same amount for every shareholder. So in that way, they're kind of comparable, except for that it's much lower buy-in on the Lowe's, right? It's a much lower buy-in. All right, dividend yield. So this is when you hear people say, oh, I earned 5% on my stock or 6%. Well, that's about how many dividends are they paying out based on what you put down for a price for the market share. So if we go back to here for a second, the dividend yield is going to come, well, we're going to see that dividend yield is 2.16%. The dividend they've paid out is $6. Okay, so we're going to put $6 over the market price for that share of stock, and there's our 2.16%. So basically, you laid out $278, you got back $6 in dividends. Is that good? Well, it's really only 2% return. Hopefully you're earning more than that on most of your investments, but better than negative, I guess, right? So here's Lowe's for a second, 1.4%. Your dividend they've paid out is $2.40. We're like, well, that's way lower than $6. But remember, you paid less for it. So 240 over 171.36, 1.4. They pay out less, but again, you have a lower buy-in, so that may be worth your while. If you don't have $300 to buy into a share of stock, you only have $200, a little less than $200. Maybe Lowe's is smarter. It's not, it's not a significant difference there. Even though 240 to 6 sounds like a significant difference. So, I mean, they're paying out more, but okay. All right, annual report. So remember, this is all about analyzing the financial statements, and we're looking at, we looked at the auditor's opinion. Oh, I never talked about the other opinions. I feel like, do we talk about, is that in here? I don't know. If it is now, we'll come back to it. Okay, so there's the auditor's opinion. This is the kind of things we talk about in the annual report. So we hit the auditor's opinion, the financial statements are in there, we know, but there's a lot of other things in the report. And there's the notes in the financial statements, the footnotes where you kind of explain things that happen on the financial statements. There's also things like the management discussion and analysis. All right, so there's the 4 financial statements there. The notes, those are required. These are audited, right? These financial statements, notes of financial statements. We talked about this. There's the independent auditor's report. That's the one for KPMG I showed you at the beginning, where we give the opinion on the financial statements. We actually also give the opinion on internal control, and that came into play with Sarbanes-Oxley, whether or not a company has good internal controls or does not have good internal controls, and so on. But there are other sections. This MD&A section, management discussion and analysis, none of the rest of this report is audited. Management can say whatever they want. Right? They can say whatever they want in the highlights, they can say whatever they want in the letter, they can say whatever they want in the MD&A, they can say whatever they want in the management report. But what they do in here is they kind of explain away bad numbers. Right? Well, not necessarily. I mean, they may say, we know that this didn't look great because of X, Y, or Z. Or we're growing our China offices, or we're growing our Russian offices. Why did I pick those two? I don't know. We're growing our offices in Singapore. So we spent more money on X, right? It's just kind of a place where they discuss with some of the things you'd see in the financial statements. It kind of explain away weird data or abnormal data. Same kind of thing goes with the management report. Now, the one thing I just want to talk about, I didn't say the independent auditor's report. You've got the clean opinion, which is also the unqualified opinion. A step down from that is the qualified opinion, where they say, you can rely on the financial statements. They present fairly in accordance with GAAP, except for blank, and whatever they except for. Now, companies do not want an except for. They want the clean opinion. So if there is an except for and they can fix it, the auditors will usually say, hey, listen, we're going to give you a qualified opinion unless you change your ways on this. And they'll usually scramble to do so if they can, because they don't want anything but the clean opinion. Right? Their stock prices plunge immediately. So you've got unqualified, which is clean. You've got qualified, which is an issue. You've got adverse. Imagine that. That's bad. That's like, you cannot rely on these financial statements. That's a kiss of death, right? And then the last one's a disclaimer. And a disclaimer doesn't necessarily mean bad. It doesn't mean good. It means we can't give an opinion for some reason. Maybe they lost all their data in some sort of, data hacking thing, right? And they didn't keep backups. Point is that accountants couldn't give an opinion. It could be good, could be bad. There's really no way to know because we couldn't get access to what we needed in order to do our job and give an opinion. So those are your 4 major types of statements. All right, I think that's it. It's a tough chapter. It's a lot of calculations. I will warn you that when you go to put the information in for the homework on this, one of the biggest complaints I hear from students is that the decimal places kill you. Okay, so pay really close attention to what number they tell you to round to. And that's the only way you kind of get through this one. But otherwise, have a great day, everyone.